Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Mayuresh and you're watching Indian Open. Let's go straight to the headlines. SR Steel's lenders want ArcelorMittal to shell out another 4,000 crores for the stressed assets. Higher raw material costs weigh in on Asian Paints margins in the second quarter. Revenues and volumes slightly higher than estimated. Bajaj Finance is expected to report a stable set of numbers in the second quarters. It is amongst the 4 nifty companies to come out with results today. And all eyes will be on HCL Tech's guidance, even as analysts don't expect any fireworks in the second quarter. Well, let's take a look at the trade setup for the day. Not too much happening in news front on the global desks, aside of the fact that crude is maybe just stabilized a little bit. I think all news around Jamal Khashoggi and what happens in terms of geopolitics, maybe not too much out there, but certainly has its impact on crude ever so marginally. Saudi Arabia, remember, says that it can raise output to offset the loss of Iranian exports that kick in come November. And maybe that, plus the US-China trade war, which is denting the demand outlook, all keeping crude oil under check, which is always good news for India. But yeah, it's been marginally under check. However, the rally in China seems to have halted a bit, and while the world markets didn't do too much in trade yesterday, Europe was a mixed bag in trade. Dow and Europe was down, US markets were down, a mixed bag essentially. So Dow Jones was down 0.5%, but Nasdaq was up 0.25%. No big cues there, but somehow there is weakness on the Asian bourses. So Nikkei started off about a couple of percentage points lower. Hang Seng is down about 1%, and the Chinese pullback rally seems to have gotten halted a little bit after a few days of gain. The SGX Nifty pointing towards a downtick as well, so we are likely to start off, if the SGX Nifty levels are to be believed, sub 10,200. Thus far, we've been bouncing back from those 10,250, 10,300 levels. If we start low and stay low, then we'll be breaking some near-term support levels that we've seen the index hold on to in the recent past. And frankly, rolls notwithstanding, the positions even on the current series on the Nifty Bank are a bit on the short side, even though the Nifty Bank has withheld the selling pressure compared to the index. The heavy institutional selling too seems to have ebbed a little bit, because frankly the last few days, these are 3 days in particular, we haven't really seen large FI sell numbers come in. Yes, they've been selling, in fact there have been muted buying as well, but those 1,500, 2,000 crores worth of selling that we've seen thus far in the month of October has just seemed to ebb a little bit. In today's session though, I would firmly believe that earnings will take center stage. We may start off lower, but there are 4 nifty names, a bunch of other important mid-cap names, all of which largely will come out during market hours, so important to watch. What's lined up? Let me tell you about those numbers. So amongst the nifty names, Adani Ports will come out with numbers, I reckon, during market hours. Bajaj Finance will come out with numbers during market hours. We'll have HCL Technologies and Bajaj Finserv coming on later post-market hours, but a bunch of important names to monitor. In fact, at the mid-cap end as well, or the non-index names as well, Ambuja Cements, and not too much is expected of cement. Can Ambuja kind of change that narrative? Watch out for that. HDFC Life and ICICI Prudential Life Insurance amongst others. Remember, insurers have gotten off to a good start this earnings season. Let's see if these two can make up for that as well. And then we have MCX, TVS Motors, and to my mind, importantly, RBL Bank. After the downgrade and the fall yesterday, RBL's commentary on how it will tide over what seems to be a higher cost regime will be very, very important to monitor. Now, all of that is during the course of the day. What to watch out for at 9:15 a.m. A few stocks that I reckon could react. Asian Paints, the volume growth was healthy, but bottom line miss on weak margins. Let's see if there is a bit of an impact on Asian Paints in the session today. The numbers came out post-market hours. We'll probably see a bit of a reaction. Yesterday's reaction was in part due to the weakness exhibited by Kansai Nerolac as well in their numbers. Oberoi Realty. Now, you may argue about what the expectations were, so on and so forth, but for a real estate company to come out with numbers like these, wherein revenues were up 95%, EBITDA margins more or less stable, you can argue there was a 400 bips downtick, but frankly, to my mind, that doesn't matter too much. PAT up about 105%. The numbers seem optically impressive. Let's wait and watch if Oberoi, which again has been beaten down in line with some of the other real estate companies, can show a bit of an uptick on a weak day of the market. The interesting one could be Welspun India. Trident came out with a blockbuster set of numbers. Everybody extrapolated this to the other companies as well. And I remember that Welspun shot up about 7% after Trident's numbers. the numbers left a bit to be desired, to be honest. Very flattish growth. The top line, bottom line, EBITDA just up about 2.2%. Margins got impacted due to higher raw material cost and higher other expenses. So let's see if this one has a bit of a reaction in today's session also or no. And last but not the least, Trident, we're talking about that. Well, the promoter group has bought about 15 lakh shares at 63.85. So after a brief spurt post good numbers, Trident too is cooled off. And the promoters group has bought some shares, so could be interesting to monitor what this one does. A bunch of others, the likes of IndusInd Bank, some of the other banks that came off, the likes of RBL, etc., would all be in focus as well. However, what's lined up on First Word today? Exposure to ILNFS has changed IndusInd Bank's fortunes. In fact, we start off with that one. Darshan Mehta will list out the concerns expressed by the brokerages. We then look at why the Sheens worn off some of the mid-cap IT stocks as earnings have taken center stage. I will dwell a bit upon that. Rising commodity costs may have hurt the paint makers' profitability. Yash Upadhyay will put the numbers into perspective. And then, to my mind, the most important number for the day, Bajaj Finance, is likely to post another strong quarter. Shraddha Babla will take us through the street expectations and what we should monitor from the management commentary. Last but not the least, SRT lenders want a better offer from ArcelorMittal. Saloni Shukla has the latest in the negotiations. Well, let's start off with IndusInd Bank. It was considered a safe bet in the banking sector with its steady growth, market share gains, coupled with good asset quality, thanks to limited exposure to large corporate NPAs. But fortunes seem to have changed a little bit for IndusInd Bank when ILNFS opened a Pandora's box of trouble. Just in yesterday's trade, IndusInd Bank dropped 7%. There's also this concern around the heightened exposure to the gems and jewelry space. But let me not dwell too much on it. Darshan Mehta is going to do that. He's joining with all the concerns surrounding the private lender. Darshan, 8% down yesterday, and now brokerages have come out and listed out the concerns as well.
Yeah, this is just Macquarie, but then we did our own research and decided to find out what's exactly happening. A couple of things were known, couple of things were not known. I think the big trigger that happened was the rights issue that failed. We'll take it one by one. It's down 30% from the all-time high, and the big drop came in yesterday, 8%. Firstly, the exposure to ILNFS, that's the big concern that there is there. Now, the bank in the second quarter made provisions of 275 crores in their books, so that was known that they have exposure to ILNFS via two entities. One of them was the Chennai Road project, and secondly was the ILNFS parent. Now, they made this 275 crore, but they didn't say what was the total exposure. That was something that was making the market uncertain, and you're seeing that slowly and steadily the share price of IndusInd Bank kept on falling because these concerns are clearly there. And since this is not known how much this exposure could be, brokerages, I was reading a Prabhudas Diladar report, and they're saying that you don't expect, they don't know what kind of exposure that is there, and that makes it difficult in case this exposure turns into an NPA. So that's the first problem, the big exposure. And remember, ILNFS has total debt of 90,000 crores among its subsidiary, but that's a problem for the entire banking sector. Now, secondly, and the most important, is this bridge loan that they gave. Now, what happened was, and this is where the real concern came in, IndusInd Bank gave a bridge loan to ILNFS, and this was before the company got rated to a default. So they gave them a 3-month bridge loan, and their commentary on the conference call was that once the rights issue goes through and there is payment that's come in, we will get our money back. Now, this didn't happen. From till the 19th, the 5th to 19th was the date when this rights issue was opened. That didn't get subscribed, so that failed. And now Money Control came out with an article saying that this will be postponed to 2019. Some of the other articles also came down. So now this money is stuck. So we don't know how much bridge finance has been done. Overall exposure to ILNFS, they haven't said, but IDFC came out with a note, and they believe that 2,400 crores could be the entire exposure to ILNFS. Now, that's not small. That's almost 1.5 times their book. So if that goes into NPA, that's a big problem for IndusInd Bank. So that's the second concern of this bridge loan, what has happened, and this thing. The third concern is ILNFS Securities. Now, they are acquiring ILNFS Security. It's a known fact. But what happened was, over the weekend, ICRA placed the A1 rating of ILNFS Security under watch. So there is not a big, but again, there's a sentimental impact because of this also. Now, the management in the conference call said that, the road project to which they have the exposure, and remember, they're not naming what kind of exposure. They have just said that 275 crores is the exposure we have taken. That is enough. We won't take any more provision. But this was before the rights issue. and then the rights issue failed. So in this road project, they say it's a AAA rated project. There's nothing, no problem that is there. But analysts say that, even being a AAA road project, the reserves are not there, the financials are not there. And in India, where stressed assets are not getting sold, this will get delayed. You may not get the best price. So there could be potential provisions that they may have to take on the road project. Some of the other concern is that they have exposure to a lot of mid-sized companies. They don't have very high exposure to high leverage companies, but a lot of mid-sized companies is where they have an exposure. And UBS says that, despite growth that is there, the exposure, and if there is any problem there, that's not factored into the price. The next problem is RBI. Now, a couple of brokerages and analysts I spoke to, they are saying that RBI may insist on banks making NPL provisions against their exposure, and if this happens, this is a big number that comes in, 1.5% that comes in, and so the NPA just goes out of the window. And the RBI divergence report is also awaited. When this will come, I don't know, but if something like in the past what has happened, when IndusInd has been fined, Yes Bank has been fined, and you know the case what happened with Yes Bank, people are now starting to doubt that. And the other concern is that if you see the second quarter numbers, the exposure on a quarter basis to the risky gems and jewelry. Now it's risky because what's happened.
Yes.
And the commercial real estate, which is failing, and what caused the crash in the NBFC, that has increased significantly on a quarter basis. And the management is not giving any proper communication in terms of what will happen after Ramesh Sokti. He is due to retire in 1.5 years now. But there's absolutely no communication. What is the succession plan? And that is having a lot of concerns among analysts. I read this in a couple of notes. So 7 points that we have highlighted. We've studied through all the notes and what would do. But that seems to be a fair concern that the street is having on IndusInd Bank.
Well, Darshan, thanks for putting that into perspective. Well, now out of these, there would have been few that could have been playing the minds of investors yesterday, because the stock had the steepest fall, I think, in over 3 years in trade yesterday, or since 2014, if I'm not wrong. 8% lower, 6.5 million shares. Darshan, thanks for putting that into perspective. That's IndusInd Bank, and the stock came off quite rapidly in trade yesterday. Okay, the next piece on First Word is for mid-cap IT. Now, I want to start off with a couple of charts before I go on to specific stocks. One is a chart that I used on countdown in trade yesterday, and the fact that the Nifty IT index has now comfortably settled sub the 100-day moving average. This has not happened in a really long time for Nifty IT, and if it continues to stay lower, you see the cluster of those green dots towards the fag end of or towards the left hand side of the screen. That's where Nifty IT seems to have settled in the last few days, and there are some, as per technical parlance, there are some bearish indicators which could take the Nifty IT down further if it doesn't manage to bounce back. So you got to keep that at the back of your mind. This is the first chart. The second chart is the valuation chart, and if you just look at the Nifty IT PE multiple, and this is something that we've argued in a couple of articles on the website as well, that you need to pay heed to valuations. If you just look at the Nifty IT valuations, they had skyrocketed to levels which we had seen only once in the last 5 years. Those two spikes, abnormal as they may seem, they indicate essentially how high the valuation levels had gone off to before we came off. So amongst the highest levels that the Nifty IT PE has trended in the last 5 years at least, if not longer. Now, what does all of this indicate? This indicates that if the valuations were pricing in the perfect delivery of numbers, and if the numbers have not been perfect, then the stocks would come off. And that's precisely what we've seen. But remember, it's not across the board. Companies which have delivered have actually done well. So let me try and highlight 4 mid-cap IT names and what happened in the quarter and the resultant valuations. Start off with Mindtree. Arguably, I have to start off with that. It's corrected about 18% post the delivery of the numbers. Now, what happened? It was a soft quarter. The near-term visibility was very blurred when the management spoke. There was uncertain demand environment, especially in the BFSI vertical. This is as per the management submission. And while the INR depreciation aided margin uptick, it didn't give too much of solace to investors, and which is why the stock corrected 18% post the announcement of the numbers. Now, keep in mind the valuations for Mindtree. It was trading at about 21 times FY19 EPS pre-result delivery. Now, after the fall, the stock has corrected, but it's still trading at 17 times for a stock which does not have near-term visibility. You got to question that, don't you? Similarly, for Persistent Systems, corrected 15% post-results, mind you, which was essentially in trade yesterday. Now, the decline in digital revenues for the second quarter in a row is something that has concerned most investors. A 4.7% first half growth lags last year's growth. Most importantly, it will lead to a less likelihood of the company able to beat the 9.7% growth they clocked in the previous year. And that would disappoint the street. Ahead of the numbers, the stock, which was not too expensive, traded at about 14 times FY19 expected EPS. Post the correction, 11.7 times, but of a stock which will not manage to beat even the 9.7% mark and showing lumpy growth, you would probably argue that it was warranted that despite the cheap valuations, there would be a reaction on the stock. Emphasis, not a big reaction, but did correct about 3.8% despite the fact that the numbers just missed estimates marginally. It was a good quarter. The revenue growth was about 2.6% QOQ, missed estimates marginally, but the deal wins were very, very strong. Solid deal wins, $210 million worth of deal wins. EBIT margin guidance maintained. They are likely to clock in lower double-digit revenue growth, which is not bad by any stretch of imagination. However, because Emphasis just about managed to meet estimates or marginally miss them, the stock got beaten down a bit, but expensive. 20 times FY19 expected EPS. After the drop, 19 times FY19 expected EPS. TCS Infosys trades circa these levels FY20 EPS. You got to ask the question as to why would the market want to pay 19, 20 times 1 year forward when the rupee tailwind also seems to be going out. So keep that at the back of your mind. But as I said, it was not all bad. The market did separate the wheat from the chaff. NIT Tech reported strong numbers and it's gained 10% post the delivery of the numbers. Now Q2 was a beat on all fronts. The revenue visibility improved. Order inflow was up about 6% quarter on quarter. There were 2 deal wins of over $20 million each. And the management saw or said that they see the deal win momentum of about $150 million plus as the new normal for NIT Tech. They were confident of margins improving from the current 18%, which they logged in quarter 2, in the second half as well. And therefore, despite the fact that it was trading at about 17 times FY19 EPS, the stock went up about 9 or 10% post the delivery of the numbers and currently trades at 18 times, which shows that if you're showing growth, the market is probably willing to give you that the P multiple, which is northwards of 15 times, be it 17, be it 18. But if you're not, then even if you're persistent, which was trading at 13 times, you will get punished to about 10, 11, 12 times as the case may be. So mid-cap IT is certainly been shown that while the stocks rallied quite a bit because of the rupee tailwind, if you're not delivering on the numbers, the street is not shying away from meting out punishment. So that was IT. The third space, of course, is consumers. The demand momentum has failed to prop up the paint sector earnings as raw material prices have played spoil sport. Both Asian Paints and Nerolac posted weak results for the second quarter of this financial year. Yash Upadhyay is now standing by to compare and contrast these numbers. Morning, Yash.
Morning, Neeraj. So you rightly mentioned for the IT how they've not been able to deliver despite the rupee tailwind. In this case, it's the exact opposite because while the demand has been quite good for the paint companies, as we've seen in the quarter gone by, the rupee headwind and the weak and the higher crude oil prices that have played a spoil sport. So as far as the Q2 numbers are concerned, both Asian Paints and Kansai Nerolac came out with a disappointing set of numbers which were far lower than the analyst expectations. But the only key positive that I would take out from at least Asian Paints' numbers is that the demand momentum continues to grow in the domestic decorative paint business. The management does not give us an exact number, but from their press release, they have mentioned that the volume growth in the domestic decorative paint business for the second quarter was in the low double digits. So it is expected to be about 10%. We spoke to the management of Kansai Nerolac as well, and they are telling us that the volume growth stood at about 9.5%. Why this is a positive for Asian Paints? This is a third consecutive quarter for the company of double-digit volume growth. And as far as Kansai Nerolac is concerned, it is a bit of a negative. That is because they've been consistently doing far higher volumes as compared to Asian Paints, and a 9.5% volume growth for them is the lowest in several quarters for that matter. Also, what was the key takeaway from the management commentary was that the demand continues to look good in the domestic decorative paint business. As we all know, Kansai Nerolac gets a significant share of their revenues from the industrial paint business, and they categorically told us that the demand continues to remain buoyant on the domestic decorative side, while the industrial paint business might be subdued. Now, the higher raw material prices, as we were mentioning, that has had a negative bearing bearing on the gross margins, which are at record lows when it comes to both of these paint makers. What are these raw materials? It is the crude and the crude-linked derivatives. We've seen crude oil prices hit multi-year high, cross the $80 per barrel mark, and that has had a negative bearing on it. To double the pain is the weaker rupee. Now, because of that, the gross margins for both Asian Paints and Kansai Nerolac, for Asian Paints, they are at about 39.8%. They've been consistently in the range of 40 to 42% over the last 3, 4, 5 quarters, but now they've breached below that level. For Kansai, they just breached the level of 40% gross margins in the last quarter, but they've been fairly stable around the 39 to 42% gross margins, and they have fallen to as low as 35.5% in the second quarter, which is a big negative. Also, the profitability, that took a big hit in the second quarter. We saw Asian Paints report a 14.5% degrowth in their profits, while Kansai Nerolac reported a 16% cut in their profitability, which is for Asian Paints the lowest in the last 4 quarters. And for Kansai Nerolac, that is the 3rd consecutive quarter of negative profit growth, which is in my opinion, not a very good thing, because Kansai Nerolac has been consistently struggling. That is because they are not easily able to pass on the increasing raw material prices to the consumers, because industrial paint business, that requires a bit of a negotiation with the company, and that tends to happen with a lag. And we are seeing all these factors translate into their profitability taking a hit.
Well, interesting. Yash, thanks for putting that into perspective as well. Let's wait and watch what happens to Asian Paints today, because I thought it partly reacted to Kansai Nerolac's weak quarter in trade yesterday itself. So let's see if there is a further reaction today. However, moving on from reviews to previews, it's likely to be another strong quarter for Bajaj Finance. Robust AUM growth is likely to be aided by consumer finance and rural book. Shraddha Babla is here to take us through the expectations from this quarter. Morning, Shraddha.
Morning, Neeraj. So first, I'm going to start off with what's expected for Q2, and then we will discuss what is important. Of course, the earnings trajectory, the strong earnings trajectory is expected to continue into Q2 as well. So in terms of the key numbers, net interest income is expected to grow by about 36%. Net profit is expected to come in 54% higher, 858 crores. AUM growth is likely to remain strong at about 35% sort of levels. This will be on the back of healthy demand that they have been seeing in the consumer segment, in which the company continues to increase its market share, and then also led by a strong growth in the rural book, which is of course on a lower base. Asset quality is expected to remain healthy. The gross NPA ratio is expected around that 1.4% mark, and provisions are expected to remain on a Q-on-Q basis. But having said that, since it is an NBFC, in the current operating environment, it is going to be important to watch out for what the management has to say with respect to the growth guidance. Also, comments with respect to changes in the funding profile, if any, are going to be important. Remember, Bajaj Finance has a positive ALM gap, which is a good thing. But nevertheless, driven by the sentiment towards NBFCs, we'll have to see what the incremental cost of funds for the company is. And then we're also going to be watching out for asset quality trends, especially in the LAP and two-wheeler, three-wheeler portfolios. But nevertheless, Q2 numbers expected to remain strong. Neeraj, any loan growth number sub 30% will probably be a negative, and the stock has come off sizably from those near 3,000 levels to about 2,200. So overall, at least Q2 numbers expected to be in line. Watch out for commentary, of course.
Shraddha, thanks for putting that into perspective. Just one follow-up. I think everybody would say this, that for NBFCs by and large, and maybe even for a Bajaj Finance, even if Q2 were to a bit damp or very, very strong, the stock performance would hinge on what they have to say for quarter 3, quarter 4 ahead, right?
Especially, exactly, Neeraj, that's what I said. So growth guidance is going to be important. Bajaj Finance has a positive ALM gap, which is a good thing. We need to see what the management has to say. Morgan Stanley had downgraded their growth estimates from about 40% CAGR for FY19, FY21 to about 30%. 30% by no means is a low growth, but let's see what the management has to do, whether they are paring down their growth or they're confident, given their positive ALM match, if they think they'll be able to grab higher market share. So that's the key thing to watch out for. It's going to be the growth guidance.
Well, let's wait and watch. Thanks a lot for that, Shraddha. I don't quite remember what did Rajiv Jain tell us when asked about what the growth numbers for FY19 and FY20 would be. I think when we spoke about FY19 the last time, he clearly mentioned that they are in the business of risk and not lending, and therefore they don't believe that 40% is a number, but 30-35% was a number that I think he had confirmed in that interaction with us as well. So maybe the street was running at a 40% and bringing it down to 30%. I think if Rajiv Jain is confident of meeting a 35% guidance, I doubt that anybody in the street would doubt it. And that might just give a bit of a bottom to the stock as well. Let's wait and watch. Has corrected quite a bit in line with some of the other NBFCs. The last piece on First Word, SR Steel and the lenders want ArcelorMittal to shell out more for the stressed company. People in the know have told Bloomberg that the banks which met on Monday to discuss ArcelorMittal's offer want the steel giant to increase the offer. Saloni Shukla of Bloomberg News has more details in this report.
Well, lenders to SR Steel are looking to extract more even after it was declared the highest bidder last week on Friday. Remember, ArcelorMittal had upped its bid to 42,000 crore prior to the Supreme Court verdict, which happened on October 4th. Prior to that, it was willing to pay 35,000 crore upfront to lenders and 8,000 crore as a fund infusion into the company, after which it had upped the bid to 42,000 crore as upfront payment to lenders, including fund infusion and payment to the operational creditors, which stands at about 1,000 crores. So currently the lenders are asking for more money. They are voting on this whole ArcelorMittal bid even after declaring it H1 on last Friday and looking to extract more from the company. So we'll have to clearly wait and watch and see whether ArcelorMittal is agreeable even after it gave the highest bid, almost about 8,000 crore more than Vedanta for the 10 million mill plant which is under distressed SRC. So we'll have to wait and watch as to what happens on it. Back to you.
Well, that's all that we have on First Word today, but lots more lined up on Indian Open. Yatin Mota heads to the Motilal Oswal dealing room to take a status check of the market pulse. Yogesh Mehta will join in to talk about what the dealing room is telling their clients to do. But we discuss more fundamental long-term investment strategies with S. Sriniwasan of Kotak Investment Advisors. More importantly, talk to him about what the pain in real estate would look like. Right after this break, though, a full tilt towards the day's trade.
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी चुनूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good, but आज की जनरेशन wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद।
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate, and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. coming. Product of the year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture a billion.
Welcome back. You're watching Indian Open right here on Bloomberg. Quint, let's hop across to see how the Asian markets are faring this morning. So a sea of red there on your screens, down about 2% for Nikkei. Shanghai also reverses those gains that we saw the bounce over the last two trading sessions. Now is down about 0.7%. For the Hang Seng, we're losing about 1.5% more. So Asia's back, looks extremely fragile in trade this morning. And you can see that as a reflection on the SGX Nifty as well, which trades under by closer to 0.8%. So we've reached the 10,200 mark on the downside. Likely open for our market. Well, no points for guessing. It's going to be in the red. But what's the setup looking like? Remember, it's expiry week, so you're going to be seeing a lot of activity on the rollover side as well. Darshan is joining in right now to take us through all of those cues. Darshan, good morning.
Good morning, Devina. And the cues certainly seem to be on the weaker side. You've seen how the SGX Nifty has behaved in trade. The Nikkei is down significantly in trade. Yesterday, what happened was the Nifty ended with a negative bias. It was trading. It had a very, very massive gap up opening. Couldn't take through the gains through the day, and fresh short positions were taken. And look at the open interest build up, almost 12%, that too on the short side. Even the Nifty Bank actually managed to come down in trade from the highs of the day. Even here, open interest build up of almost 11%. Now, where are positions taken? We are clearly seeing that there is negative traction that's happening. What we are seeing is that put writers are active from levels of 10,300 to low levels, and call writers active from levels of 10,300 to higher levels. We are pretty much at these levels. So what will happen if the market continues to slide? And if the SGX Nifty is indicating a 85-point gap down, positions at 10,400, 10,500, and probably even levels of 10,200 will get squared. The market will go down significantly, and these green arrows will come up significantly. That's the total open interest. If you're looking at what happened in trade yesterday also 10,200 saw significant amount of open interest build up on the 10,200. So that's an immediate support that the market is looking at, which will be breached in trade today. Couple of stocks in the F&O band and the Nifty PCR will highlight. The India VIX was up almost 8%, again above the 21% mark in trade. As far as the PCR is concerned, the Nifty PCR remains stable. The Bank Nifty PCR also remained pretty stable in trade. Now, Adani Enterprises is the new stock in the F&O band. Dewan Housing goes out of the F&O band. It was down almost 11% in trade yesterday. A couple of stocks that I want to highlight yesterday. HCC saw long unwinding. Open interest was down almost 7%, and the counter now coming close to the 10 level mark in trade. The other stock I want to highlight is Bajaj Finance. Was trading up almost 3% in trade. From that, it crashed down to a negative almost 1% on a decent open interest deduction. So there was serious amount of long unwinding that was happening in Bajaj Finance. And finally, Hindustan Zinc came out with a decent set of numbers. Open interest built up was 38%, gave a strong dividend also, but the street not too enthusiastic with the numbers that came out, ended down almost 1.5% in trade.
All right, Darshan, thanks a lot for that. That's the F&O snapshot that we are seeing in trade today. Rollovers, you will obviously see them picking up over the next few days as well. Mayuresh Joshi, a fund manager at Angel Broking, is joining in right now with his views on the market. Mayuresh, how have you positioned yourself? Looks like there's more eminent weakness in the market right now, considering from where we're taking off with Asia looking extremely fragile. Aside from that, the numbers that have been coming in seem to be disappointing the street one after the other. And now keeping it to the numbers coming out from the paints segment yesterday, both Kansai, Nerolac and Asian Paints disappointing.
Morning, Devina. Again, I think the volatility in the markets is expected to continue, and though we've seen respite specifically on the Brent pricing, I think the concerns that the market have at this point of time, specifically related to the NBFC and the contagion effect that it might have, is clearly getting played out. So I think the nervousness and the fragility of the markets is clearly getting displayed on all sectors. Yes, a few earnings have been disappointing. I think mid-cap IT has largely disappointed, barring a few. I think NIT Tech was the only exception that I see in the reported numbers so far. But again, I think paint companies, as you mentioned, I think it was always expected that with the crude price increase that we've seen, the lag effect in terms of increase in crude derivatives does play out on the margins. The rupee depreciation also not helping in any manner. So the amount of pass-through that these companies can do, and yes, they have taken price hikes, but the extent of price hikes and the kind of impact it has on volumes, I think that was clearly getting displayed in the displayed numbers in the quarter gone by. But largely, again, I think when you're talking about the expectations of demand and the painting demand, specifically the repainting demand, the cycles have probably shortened. So what happens in the next few quarters with repainting demand coming back strongly, I think should benefit these players. But largely, yes, I think the earnings in terms of reported numbers for the quarter were very, very disappointing.
Good morning, Mayuresh, Darshan here. What do you make of IndusInd Bank? Big knock, down 30% from the recent highs, down 30%, 8% in trade yesterday. Is ILNFS such a big concern for IndusInd Bank that there could be more potential pressure on the counter going ahead?
So morning, Darshan. No, again, I think the kind of provisioning that they've made, and the management seems to be very confident that whatever they've provided for should probably suffice. So what the street is probably fearing is whether there are any accelerated provisions required for the ILFS transaction in the coming and ensuing quarters. At the same time, what probably happens in terms of the microfinance arm that they are taking over and the expectations of any credit loss or asset quality pressures emanating from that business stream. And the third element obviously is the overhang that we've probably seen after the expiry of Mr. Sopti's tenure, although it's a long way away. So I think these three concerns are getting played out in terms of the stock price movement. But from a fundamental perspective, again, I think the balance sheet growth has been pretty robust. When you're talking about asset quality pressures itself, I think they have been maintained at stable levels. Even the provisioning that they probably did, even if accelerated provisioning in a worst case scenario is required, I think they do have the adequate resources not to impact growth and profitability, by which they can still keep on providing, not just for whatever accounts that probably might go bad, but also in terms of creating an accelerated provisioning for the doubtful book, so as not to be too much in divergence with RBI. At the same time, I think if you're probably talking about expectations of return ratios, they've always been high. So again, I think the kind of growth that they've displayed and the kind of franchise that they've probably built, I think the CASA ratios are extremely strong. And I think in a certain way it just justifies. So yes, I think I remain positive on the bank. I think these concerns might be playing out on the stock in the short term, but I think earnings will stand out from a medium to long term perspective.
Okay, Mayuresh, just hold on. The other important, we discussed numbers that will come out and the previews from companies like Bajaj Finance. The other important number that will come out after market hours is HCL Tech. A higher wage bill is expected to keep HCL Tech's second quarter earnings growth in check, even as the rupee weakness is expected to aid the top line. Agam Vakil is standing by to take us through what the street is expecting from the company.
Well, we're not expecting any fireworks from HCL Technologies second quarter, considering an expectation of 2% when it comes to its constant or rather dollar revenues at around $2,096 million. Your income from ops is expected to rise 6.3%, and margins are expected to remain largely flat around 19.8 versus 19.7 quarter on quarter. Net profit could rise as much as 1.2%. We're expecting them to maintain their guidance at around 9.5 to 11.5% constant currency terms, and margins are likely to remain between 19.5 to 20.5%. Organic growth is seen at around 1.4%, and while we do expect some benefits to come on the back of the depreciating rupee, do remember that the company will take into account the wage hikes and salary hikes this quarter, which is likely to offset the benefit of the currencies. Moving in, we're keeping an eye on how its Mode 2 and Mode 3 businesses do. On the whole, not expecting too much from HCL Technologies, expecting a steady quarter, much in line with its peers.
All right, a steady quarter is what we're expecting, but that's not what the street likes this time around from the earnings season. So unless it's a significant beat, well, IT as a pack looks extremely weak, and the kind of numbers that they've been posting, if they meet expectations, then there is a disappointment on the stock price performance. Mayuresh, HCL Tech, and what's expected from there, from you?
No, Devin, I think as Argam was mentioning, I think we're expecting a reasonable amount of constant currency growth. But I think the main points that need to be observed are the kind of organic growth that the company probably posts. And the expectations largely are that the organic growth is expected to be muted. Now, the investments that they are doing in the Mode 2 and Mode 3 strategy, what kind of dividends that pay out to the company is going to be extremely critical. At the same time, I think the kind of TCV wins are going to be extremely critical in key business segments, whether that's IMS or engineering and R&D. So I think these are going to be drivers for the company going forward. And yes, I do not expect them to tweak both the EBIT guidance at 19.5 and 20.5, the band that they are working out with, or even the constant currency guidance at this point of time. But I think management commentary is going to be very, very interesting in terms of the business environment, the landscape that they probably look at.
All right, Mayuresh, just stay on with us. We're going to come back to you with more questions. But in the meantime, let's go across to our research team, all of them ready to talk about some stocks in news and some more results, just because we're in the midst of the result season and the kind of reactions that those stocks can expect. I'm going to start off with you, Shraddha, first in some stocks in news.
So a couple of order wins, Devina. One is Himachal Futuristic. They've received an order worth 366 crores. That's an advance purchase order from BSNL. ITD Cementation has also bagged multiple orders worth about 1,066 crores. Then there is a small cap company, relatively illiquid, Orient Press. They have received an order from Maharashtra Pollution Control Board, which has directed them to stop all manufacturing activities at its Tarapur plant. Now, this is an important plant given that the company derives about 45-46% of the revenues from this plant. So you may see some sizable reaction there. And finally, in bulk deal, investor Ashish Dhawan has sold 80.6 lakh shares in Hathway Cable. So those are some small names to keep track of.
All right, and Nikki, we've got some more results to watch out for.
I'm going to start off with Oberoi Realty. Good set of numbers reported by the company. Top line growth, we're looking at a 95% uptick there. 592 crore compares to 300 crore that we've seen in the corresponding quarter. EBITDA has been, it's a strong operational show, 80% uptick. Margins at 50 as compared to 54%. Higher revenue cost efficiency and lower depreciation along with the sharp jump we've seen in other income has led to a good show. But then notably in terms of the balance sheet position, we've seen a long-term debt of around 654 crore in the first half of this financial year. Canfin Homes, now a weak set of numbers. The net NII has just grown by 2% in this quarter. Net profit has grown by as much as 7.5%. Fee and commission income, which has fallen by as much as 25%, has weighed on the earnings of the company. Welspun India, extremely disappointing set of numbers. Revenue up by as much as 11%. EBITDA is flattish, but then the margins at 16.3%. That's the lowest that we've seen since the Q2 of 2013. So that's mainly on account of the raw material costs and higher the other expenses, which have weighed down on the financial performance of the company. Lakshmi Machine Works, so that's a mixed set of number reported by the company. Revenue 35% uptick there. Operationally strong set of numbers, 43% growth there. But then we're seeing a decline coming in on the profitability front, and also the company has declared is going to be buying back 2.66 lakh shares at around 6,000 each, which is a discount of more than 3% from the current market price. Cafla India, that's operationally strong quarter reported by the company. Revenue is up by 19% for this counter. EBITDA has also seen a fair amount of growth at 19%, but the profitability has seen a downtick of around 5%. That's mainly on account of exceptional expense of 39 crore, which has been booked on account of merger in this quarter.
All right, Nikki, thanks very much for that. So those are some numbers that you need to keep a track of. Mayuresh, just want to pick up one number that Nikki highlighted, and that's of Oberoi Realty. Optically, the numbers look really strong, though she did mention the element of the other income there. But what would you make out of Oberoi Realty's numbers, and especially considering at the position in which most of these real estate companies are right now?
So I think a decent set of numbers in my opinion, and again I think the kind of revenue recognition norms that these real estate companies need to follow is extremely critical. So I think if the projects are not going to hit the revenue threshold for real estate companies in general in a periodicity of time, I think it's very difficult to probably start capturing the cash flows. Having said that, I think the expectations in terms of both Enigma as well as Eternia actually contributing in terms of the revenue threshold, I think that can prop up the overall revenue recognition on their balance sheet. At the same time, I think if you're talking about the kind of land bank that they've got and even the rental assets, so they have hiked rates for the Oberoi Mall rental facility in Mumbai by 200 odd rupees. The Commerce 1 renting out has improved significantly, and even the Commerce 2 commercial facility, I think, is showing significant signs of traction. So the kind of developments that they're doing there, even in terms of the Borivali Mall that they're putting up, or the exquisite luxury mall that's expected to come up with Worli with an hospitality area of 0.78 million square feet, I think the annuity of the rental assets should probably hold Oberoi in good stead. I think the residential part of their business, again, I think the kind of sales that we've probably seen or heard from the street, both in terms of Esquire, where the subvention scheme has done wonders in Q1, or even the bookings related to Exquisite, I think they look quite reasonable. So in my opinion, again, I think one of the better stocks that the investors can probably hold.
Okay, Mayuresh, just hold on. We have some news, and the news that came in the Economics Times today is Lakshmi Vilas Bank is said to be looking to sell some stake, and reports suggest that it's already shortlisted 5 bidders for the sale. Joining us on the phone is Parthasarathy Mukherjee, Managing Director and CEO at Lakshmi Vilas Bank. Thank you, Mr. Mukherjee. Good morning. Thank you for joining in. News reports coming in that there are already 5 players which are shortlisted to take stake in your bank. Can you clarify, sir, exactly what's going on right now?
Actually, there's nothing much that I can mention at this moment. The process continues. Our advisors are working on this. We had called for bids, and bids had been received, and they have indeed shortlisted a few names, but that is about it. At this moment, I'm unable to say anything more.
Bids that you shortlisted, how much % stake is being sold? Who exactly is selling the stake?
Those are matters for discussion at this moment. I'm unable to share anything further at this moment.
Okay, so interest are now only being seen from PE funds. Any banks that have shown interest in acquiring stakes, sir?
I am unable to discuss specific names of bidders, so I am unable to give any information on that at this moment.
Can you just give us a color on exactly by when you're looking to complete this deal?
Well, obviously, it's our effort to complete capital raising at the earliest, but this is in a long process. It's quite an elaborate process, and there are multiple phases that we have to go through. It would be difficult for me to put an exact timeline. All I can say is that it will be our effort to close this at the earliest.
But you wouldn't know whether it would happen within this calendar year or get pushed forward?
Well, it's a part of the process. Frankly, I really can't put a timeline on it. There is no way I can really give you a sense on how soon this will be completed.
Do you have the RBI approval for the same, and are there any other future approvals that need to be taken which you don't have at the current point of time?
Depending on the structure of the transaction, I'm sure multiple approvals might be required, and these will be sought at the appropriate time.
But sir, at least give us some clue in terms of who's selling. You've said that you have invited bids, but at least what are these bids for? Who exactly is selling? Are the promoters selling? Is any institution selling? Where will the money be coming in? Will it come into the bank, or will it go to the person involved?
You will appreciate that the bank has announced that it is wishing to raise capital. In other words, it is the bank that will be issuing shares.
Okay.
So, use of these funds, where are you going to put them in?
I beg your pardon?
The use of these funds, once the deal is complete and you get the money, what are you going to use it for?
Well, obviously it is to strengthen the bank's capital base as well as fund the future growth of the bank.
Okay, so that means it will be fresh shares that will be issued to the new buyer. Is that the scheme of arrangement, sir?
definitely that is intended.
Okay, and finally, before we go, sir, everyone's talking about the issue that's happening with ILNFS. Does Lakshmi Vilas Bank have any exposure to ILNFS, any of the ILNFS subsidiaries also? And if yes, what's the quantum, sir?
I cannot discuss any specific customer details, but the bank did make an announcement earlier that it has some exposure to a subsidiary of ILNFS.
Okay, sir. Thank you so much for taking the morning call and answering all the questions. Thank you so much, sir.
Yep.
Well, technically, he didn't answer any of the questions, but very guarded in terms of the answers there.
Okay, let's get in some technical analysts. Brijesh Singh, Senior Technical Analyst at StockAxis, joins us on the show. Good morning, Brijesh. What's the trade setup looking like? A century down on the SGX. Yesterday, the SGX 50 in fact was indicating a negative outlook. It opened strong up 100 points but came down through the day. Is this a sell on rally situation that you're looking at?
Good morning, everyone. See, no doubt the trend for short term or say even for the medium term right now has been down. And obviously the some important support has been broken and the volatility had been increased. So overall the trend has been down. If we talk about on the higher side, Nifty has to be closing about 10,385 to move up for a shorter term time frame. It's been concerned. So 10,385 would be acting as a resistance. Anything above that, then we can see a sharp pullback rally. So right now, what I'm been looking is that chances are that Nifty try to touch 10,040 or say 10,070 mark before fresh buying would be coming in. So if someone is looking for a intraday point of view, definitely if a little bit gap up or say not gap up, a gap down or a flat opening happens, then definitely one can go for a sell side on Nifty with the 10,220 or the 10,240 mark would be the level where one can go for a short with a stop loss of 10,275 and play for the recent swing low that was 10,138 if I'm not mistaken, and below that would be 10,070 or say 10,040 mark.
All right. We'll come to your top calls and your stock ideas as well, Brijesh, in just a few moments. But time now for a special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock or a trend that he's picking up. Yash, what's on your radar today?
Good morning, Devina. So we are tracking ONGC on the charts today, and the stochastic indicator that has turned negative, indicating a sell signal. But before we look at the charts, let's try and understand what the stochastic indicator is. It basically helps in identifying an overextended price move, and it measures the current price relative to the highest highs and lowest lows. It's easy to interpret. Overbought is at 80 and oversold is at 80. Any crossover indicates a buy and a sell signal. As we can see on the chart, which will come up right now, following yesterday's move, the blue line, which is the stochastic line, that has crossed below the white line, generating a sell signal. Now, after the government's move, asking the OMCs to bear some of the losses, we've seen gas players such as ONGC also come under severe selling pressure, after which the stock corrected close to 20%. If we could get the price chart up again. That's taking a bit of a time. Yeah. So we saw sharp correction with the stock going from the levels of 180 plus to as low as 145. And since then, we saw a bit of a relief rally with the stock coming as high as 170. But the move that seems to have overextended, and over the last 3 trading sessions, we've seen that the stock has been under severe weakness and is now trading below all of the key moving averages, indicating that there could be a further downside when it comes to ONGC.
And how accurate is this?
So over the last 1 year, every time you went short when the indicator turned negative, it would have given you positive returns of as much as 8%.
Okay. Yash, thanks very much for that. So that's Bloomberg Edge for you. And
let's ask a technical analyst on what the charts are indicating. Brijesh, any view on ONGC?
Definitely on a shorter term time frame, the charts or say on a weekly chart also, if we see the stock had given a sell signal, and from the level of 1 till it had not been closing above 180 or 182, we won't be seeing a sell on rise or a sell signal would be generating. Now on an immediate basis, what I've been feeling till the stock doesn't trade above 162, one can take a sell side in it with a current rate is somewhere around 156, so one can go for a sell side. Somewhere around 145 to 147 is the level where the support would be coming. But the only problem is what the increase in volume indicates, that if it gives closing below 145, then we can see one leg of panic selling taking to the level of 128 to 130.
Okay, Brijesh, I'll just get to you for your calls on the index and stocks. But before that, Mayuresh, what's your view on the NBFC space? I believe you must be getting a lot of queries from your clients. What exactly is happening? Most of these stocks have corrected 25-30%. So what's your answer to them? Should you buy at these levels? Do you feel that there could be more potential downside? So if someone's looking to play the NBFC story, what strategy and which is the best play to take and which is the best to avoid?
No, so Darshan, again, I think the kind of apprehensions that one really has within the entire space itself, both in terms of short-term concerns on whether they are able to manage their asset liability mismatch, and now numerous reports have been floating around in terms of the repayments that a few of these NBFCs need to do over the next few quarters, that might put elevated pressure both in terms of how their cash flows will pan out, and clearly again I think in terms of the growth parameters as well, with the rates which have shot up in the CP market or the short-term market as well, whether they'll be able to probably borrow money in terms of funding their balance sheet growth. So I think both these aspects are at a confluence at this point of time, which is clearly creating the kind of earnings scare that one probably looks at. Add to that, I think any potential and probable defaults will also have a bearing in terms of their asset quality, and that again will entail higher provisioning. So I think the cash flows and the expected hit on profitability and earnings is something that is hitting these NBFCs very, very hard. But our opinion is that well-capitalized NBFCs where the debt equity levels are not too high, where the leverage is not too excessive compared to the system, I think those NBFCs can still be looked at. On the other hand, again, I think the NBFCs which are rather in the retail space, rather than wholesale funding, lap funding, where the concerns of the street probably are existing, seem to be a very good and probable bet. So near-term concerns can play out on all NBFCs, but our sense is that stocks like Shriram Transport, Chola Finance, or declines in a staggered way is something that investors can look at.
Right. So yesterday there was a Morgan Stanley report which spoke about how the larger private banks are well positioned to capitalize on the market share losses that most of the NBFCs, because of the liquidity crunch, are going to be facing. And you could see that in the form of acceleration in their PPOP as well. According to you, what are the best placed banks right now to capitalize on this?
So Devina, again, I think a large element of what we've been liking still continues. So I think banks like ICICI Bank, HDFC Bank still probably remain one of our top draws. Again, the large element in terms of how their growth has been, specifically in terms of advances, looking into the aspect that their tier 1 capital remains extremely strong, which is going to be very, very critical in times like this, that is still going to fuel their balance sheet expansion. At the same time, I think the asset quality pressures, say for corporate-facing banks like ICICI and Axis, either through recognition of the drill down in their watch lists and the elevated provisioning that they have done, that might very well continue for this quarter and the next, considering the power assets which are still going through stress, some of the exposure that they've probably got in the SME, MSME universe, or even some of the NCLT cases which have probably not got resolved at this point of time. So provisioning might still remain elevated, but over a period of time, as retail advances are growing at a very fast clip, and as the asset quality pressures start ebbing down, I think the credit costs should ebb down as well. Similarly, I think for HDFC Bank, stellar set of numbers. So with expectations of growth continuing at the same pace, our own sense is that these banks obviously benefit. And yes, I think at the expense of public sector banks not able to lend, specifically banks which are under the scanner in terms of balance sheet issues, as well as the liquidity issue for NBFCs, these banks should hold up.
Okay, Mayuresh, just hold on. Brijesh, before the pre-open, what's the stock strategies that you have for us today?
See, I'll go with a hotel. Indian hotel looks good on the chart right now. 128 it got closed, and yesterday the on a shorter term time frame of the chart, it was been showing a higher lows formation with a trend line breakout, increase in volume. So right now it's been giving a bullish sign, but anything below 126 one can take a buy call with the stop loss of 123 and play for the target of 133 to 134.
All right, Brijesh, I'll leave it at Indian Hotels. We'll come back and talk about the other ideas as well. We've got about 10 seconds left to go for market pre-open, and it looks like a shaky start this morning with the SGX Nifty now down over 1%. So 1.2% given up on the SGX Nifty, crumbling pretty quick since the last time we took a check. Market pre-open on your screen on expected lines. The Nifty opens lower by about 1%. 10,137, the crucial support level of 10,200 being taken down in a rush. Sensex is at 33,961. So half an odd percent cut coming in on the Sensex, but these prices will stabilize. We're going to be keeping a close eye out on not just in the index, but what's been happening to individual stocks as well. Indiabulls Housing seems to have opened, at least the pre-open tick, showing you a 10% cut in early morning trade after that 9% move on the upside yesterday. Asian Paints also another 10%. Remember, we were talking about how the numbers are a bit disappointing on the margins front. The stock started to give way towards the end of yesterday once Cancer and Aerolac numbers came out, but it's showing you a dip of 10% in today's session at pre-open at least, but this will stabilize. Z is down about 3% odd. Bharti Airtel is down 2.5%. Indiabulls Housing now cools off, so it's down 1.8%. HDFC Bank is down 1.2%. Power Grid is down 1.1%. Vedanta, ITC, Grasim, BPCL, TCS, these are all amongst the losers on the Nifty right now. Amongst the gainers, Coal India is up about 3% Infi is up 1%. UPL, Bharti Infratel and Dr. Reddy's are some of the other names that are showcasing amongst the gainers list. But just before I give it over to Darshan for the mid-cap names, just a quick look at the currency. So the currency is at 73.79. So there's some amount of weakness that's come back in, moving and inching its way back towards 74.
Okay, some of the mid caps. HSIL is down 20% in pre-open. Asian Paints, as Devina already pointed out, is down in trade, but these are pre-opens that could change. Just Dial is seeing a downtick of 10%. Dewan Housing is seeing a downtick of 10%. Infibeam is seeing a downtake. Dish TV continues to bleed further. And look at what's happened on the entire paint space. Berger Paints is down 5% post how Kansai as well as Asian Paints came out with disappointing set of numbers. Indiabull Ventures continues to bleed down in trade. Specifically on the gaining side, there is Lakshmi Vilas Bank, which has news for itself. Aegis Logistics, which is up almost 6%. Now let's get to the numbers that came out. Oberoi Realty, pulled that up, came out with numbers after market hours. It was a mixed set of numbers, but slightly on the better side. Opens positive. Lakshmi Machine Works results were decent. A buyback, but the buyback price was lower than what it was, and that is why, because of the buyback at a lower price, it's down in trade. Schaeffler India, mixed set of earnings, but slightly it was operationally it was a decent set of numbers, has unchanged. Omax Auto was weak in trade, so let's pull up Omax Auto to see what exactly is happening there. So that's Omax Auto. We'll pull that up. Hathway Cables is something that I want to pull out in trade. Ashish Dhawan was sold in 80 lakh shares in the company. It comes in the ASM framework, so that's what's happening on the market. The market's currently bleeding, not the best of start at this point of time. But an interesting brokerage note that has come out, and that is on the oil and gas space. And Nomura has downgraded oil marketing companies to neutral, citing the marketing margins look unlikely to least in the near term. That's what they say. So Amit Sarkar joins us with more on the brokerage note. So Amit.
So good morning, Darshan. On the big brokerage call for the day today we have is Nomura on the oil marketing companies. Now, according to the brokerage, if oil prices remain strong and the rupee remains weak, then that could result into further populist measures by the government. Now, earlier oil marketing companies were able to recoup their marketing margins after a drop, but regaining marketing margins at this point of time looks unlikely, at least in the near term, says the brokerage. Now, along with this, the brokerage is also expecting the oil marketing companies to share subsidy burden as oil prices are rising and LPG kerosene consumption is increasing. Now currently if you see, oil marketing companies have a strong financials as compared to the upstream companies, and this might lead to subsidy sharing with the upstream companies for the oil marketing companies. Lastly, stake sales by government is another overhang on the oil marketing companies. On the back of these concerns, the brokerage has downgraded all the three oil marketing companies, that is Indian Oil Corporation, Bharat Petroleum and Hindustan Petroleum, to neutral from a earlier buy rating. It has also cut the target price on all the three oil marketing companies. For Indian Oil Corporation, it has cut the target price to 140 from 220. For BPCL, they have cut it to 310 from 555 rupees, and for HPCL, they have cut down the target price to 230 from 415.
So Amit, thanks very much for that. That's the oil marketing pack in focus. Brijesh, I'm going to come back to you. We left you at Indian Hotels. That was one of your buy ideas. Your other call is on GSFC.
Yeah, see, on a shorter term time frame, same pattern how the Indian hotel has been there. So higher lows formation, increase in volume indicates that the more upside is being left. So if I'm not missing, yesterday it got close somewhere around 94.5 or say 95 around. So anything below 93.5, one can take a buy side with the stop loss of 91.50 and play for the target of 99.200. This might be achieved within a 2 or 3 trading session.
GSFC, there's the other one along with Indian Hotels. Mayuresh, anything in particular, any stocks that you want to put your money in?
No, so as we've largely discussed, Devina, I think a few of these larger private sector stroke corporate banks are looking very interesting over the medium to long term. What we've also seen in terms of a few consumption-driven plays. And yes, I think the kind of numbers that are expected specifically in terms of FMCG or consumer staple companies, I think the volume growth is not going to be as stupendous as in Q1 because of the low pace that it witnessed in that quarter. But again, I think management commentaries are indicating that even if they come down to mean levels, I think the volume growth is still going to be quite reasonable. Input cost pressures have played out, but again, a large element of the pass-through has probably started taking place. At the same time, I think the direct retail reach in terms of direct distribution is probably cutting off their wholesale links, and that is providing greater leverage in terms of the operating margins. SKUs and more product innovations are also probably expected to prop up the strong moats that these companies have created. So I think a few of these FMCG consumer staple companies, companies like Dabur, for example, Imami, HUL, we're talking probably about Whirlpool India, look pretty interesting at this point of time.
What about Reliance at this point of time? Reliance has been under a lot of pressure of late. Post the number is corrected almost close to 10%. Worth putting money on Reliance now?
So Darshan, again, I think the disappointing element, if you may put it that way, was the refining margins, which came in at $9.5. But again, I think let's understand, once the International Maritime Organization rules start coming into play from January 2020, you're probably going to see the blended diesel margins actually improve for Reliance, because middle distillates actually compose around 45% of their overall refining mix. So GRMs are definitely going to improve for Reliance from the current levels. The other element in terms of the core projects that were probably happening, both in terms of the off-gas cracker or even the petcoke gasification, I think that is incrementally going to add in terms of the petchem earnings and the refining earnings as well. So the kind of replacement that we're probably talking about in terms of feedstock, with shale ethane probably taking over the more expensive ethylene at this point of time, I think that is going to prop up the polymer derivative value chain that Reliance probably possesses at this point of time. Retail and telecom, I think they have surprised. So if you look at the retail numbers, though the EBIT margins might have come down a tad bit sequentially, I think look extremely strong, and so does telecom. So with the expectations of a large capex actually in the price, even on their broadband services and the rollout that they're probably doing with the acquisitions, I think the overall SOTP values should probably hold up. So yes, I think if there is any significant decline onto stock, it does become a buying opportunity. With a clear disclaimer, I do hold this stock in my funds.
Mayuresh, any view on the IT space now, since the rupee has actually turned A lot of counters have started falling. You saw the numbers that came out from Mindtree. The only exception in the mid-cap IT space right now is NIT Tech, which came out with decent set of numbers. But Mindtree disappointed, Persistent disappointed, Infosys, TCS lackluster. HCL will come out numbers today. Has IT or mid-cap IT topped out as of now?
So IT is the only bank which has held up so far, and as I mentioned earlier, I think the mid-cap IT has disappointed with the exception of NIT Tech. So I think the large element in terms of the rupee movement against the dollar, I think that is one variable, but that's not the only defining variable for IT companies, because a lot of IT companies have a hedging policy in place. So yes, in terms of a translationary nature, because of the rupee movement, that acts as a tailwind. But again, I think in terms of reported numbers, you've also seen cross-currency headwinds play out. And again, I think the offsetting effect was largely played out because you did have few elements in terms of wage hikes that a few companies needed to do. But again, I think the interesting trend and the more encouraging trend was that the order wins, the TCVs, specifically in the digital arena, and in key spaces like BFSI have shown signs of improvement. So for bigger players, I think retail, manufacturing, the life sciences part of the business had held up, but BFSI I think is going to be a more defining and a critical trend. Now you're approaching Q3, Q4, Darshan, where Q3 will have a lot of holidays and furloughs, and Q4 will be a more defining trend in terms of more constructive spending on the discretionary side by US corporates, specifically in the BFSI space. So next 2 quarters are going to be very, very interesting. They are obviously a little bit softer than what one really expects in Q2. But utilization levels are improving, attrition levels are going down, and TCVs are improving. So I'll not paint the entire sector with the same brush. I think the top players definitely have put on a good show than the mid-cap players.
Okay, 4 minutes for the markets to go. Brijesh, anything interesting that you're spotting in pre-open? Any stocks that catches your eye?
No, right now I would be away from the market. Let the market open, whether it's been a gap down and if it's settled and if it give a bounce back. Definitely sell and rise strategy would be there. But right now I would be away from the market.
Just very quickly, would you short Asian Paints? It's down 5%. Would you short it? Do you see more weakness? Brijesh, that was for you.
See, yeah, okay. See, if it's Asian Paints has been concerned, still the stock on a hourly chart basis has been moving on the making a lower highs formation. So 1200 or below that, definitely one can go for a sell side. I am looking stock touching 1135, and if it give closing below that 1135, then another 50 to 60 rupees can be seen downside more.
All right, we're just minutes away from market opening, and I'll quickly tell you all that you need to know to stay ahead of trade today. It's an earnings heavy day today. 4 nifty companies will report earnings today. The list includes the like of Adani Ports, Bajaj Finance, Bajaj Finserv and HCL Tech.
High raw material costs led to a disappointing second quarter for Asian Paints. The paint maker missed estimates on all fronts.
Among other companies that reported results post-market hours yesterday, Oberoi Realty, Lakshmi Machine Works, Schaeffler India report strong numbers, while Welspun India, Canfin Homes and Omax Auto disappointed.
A couple of bulk deals in the news. Jasmine Capital sells in additional 71 lakh shares in DHFL, while Ashish Dhawan sells 80 lakh shares in Hathway Cable.
Lakshmi Vilas Bank shortlists 5 investors to sell stake. As per an Economic Times report, the management tells Bloomberg Quint that the process is underway and that it is difficult to put a timeline on the deal completion.
Nomura downgrades oil marketing companies to neutral as they believe that regaining marketing margins looks unlikely, at least in the near term. 2 minutes for the markets to go, and let's talk about some of the stocks that are moving in trade. Asian Paints continues to bleed. It's down 5%. Indiabulls Housing Finance is down another 2% and 3% in trade. Eicher, Indian Oil, HDFC Bank, all the counters are trading with a negative bias. The only 2 stocks which are trading with a positive bias on the Nifty are Adani Ports, which is up 0.6%, and Dr. Reddy's, which is absolutely flat in trade. Devina, anything you're spotting?
Well, quickly before we go on, we're going to take some top calls from both our technical experts before we hit the screen in terms of the market opening. So I'll start off with you, Brijesh, your top call.
See, as I have said, Indian Hotel looks good on the chart. So any dip can be used for a buying purpose with the stop loss of 123, with the target of 133, 134. And second call would be a GNFC, what I have said. Any dip below 193.5 can be taken as a buy side with the stop loss of 91.50. Play for the target of 99 to 100 rupees.
IndusInd Bank, after yesterday's move, how is the pricing looking to you in terms of an entry point, Brijesh?
See, still the trend has been down 1449, it got close. So even from an investment point of view or even from the trading point of view, I would be away. Stock once looked like it has to touch 1380 or below that to give a bounce back. So if it trades somewhere around 1380 or below somewhere around 1316, that this range of 1360 to 1380, then one can take a buy call and with the stop loss of 1320 and play for the target of 1450 to 1460 zone. This is for a short-term trading bet I'm talking about.
All right, that's IndusInd Bank and some other strategies that Brijesh spoke about. But we're about 6 seconds left for market opening, and as the pre-market indications are, we're going to be opening with a gap down open of about 1%. That's the Nifty for you at 10,156, 88 points given up. Sensex loses an equal amount, closer to 0.75%. Banks are something that you need to look at and how they've opened up for trade. Yesterday's session wasn't particularly good for them. Today's session, the Bank Nifty looks like we've opened up down about closer to 1% as well for the Bank Nifty. If you can quickly get the heat map on, there's a mid cap and small cap index as well. So pain across the board, nothing spared this morning, but it doesn't look too exaggerated. On the Nifty at least, you've just got about a handful of 5 stocks making into the green. Adani Port, which reports numbers today. IndusInd Bank sees a little bit of a respite after yesterday's big massive sell-off of 8%. Coal India, GAIL and Yes Bank marginally in the green, though you are seeing a few of them pop up into the green yet again. Amongst the bigger losers and everything else that's red, Asian Paints is down 4.5%, almost 5% lower. It already started to make its move on the downside yesterday post Kansai Nerolac numbers. Margin concerns weighing down on the stock. It's down 4.5%. IOC, BPCL, so the oil and gas companies once again reeling under stress. Reliance Industries, remember, has been a key underperformer over the last few sessions, bearing down on the index moves itself. Today, once again, you're seeing a cut of closer to 1%. Other losers on the Nifty from the banking space, and HDFC Bank's down 0.5%, SBI is down another 0.5%, and ICICI Bank, which was up in trade yesterday. So 2 private sector banks, HDFC Bank and ICICI Bank, traded positive, both of them losing up in today's session. And Infosys is marginally in the green right now. But this is the market space in terms of what the index movers are doing. Just a few stocks that I'll quickly highlight before I toss it over to Darshan to talk a little bit more about the broader market space. So some results that came out in post-market as in trade and the reactions to that. So Oberoi Realty, while optically the numbers looked really strong, market really not too excited about those numbers, is marginally lower in trade today. Omax is the other one disappointing in the streets. The stock's down 10%. And Lakshmi Machine Works, the buyback price actually coming in lower, is something that's probably disappointing the street, and the stock's giving you a cut of about 5.5%. The other one is Lakshmi Vilas Bank. Now, we did speak to the management about the stake sale. They're not being able to confirm the timeline, but they are going to use the funds for capital growth. The stock's up about 3.5% in trade right now. And finally, to just take a look at what's been happening among some of the IT mid-cap names, Persistent Systems, which was heavily knocked up in yesterday's session, closer to 15% lower, is seeing some bit of a rebound in today's trade, up about 1.75%. Mindtree and Emphasis continue to reel under pressure. But Darshan, what are you picking up?
Berger, Asian, Kansai, all of them are down significantly in trade. That's the first sign that you're getting in. NLC India, that's Neyveli Lignite, is down 7.5% in trade today. That's down in trade. Infibeam continues to bleed. It's now below, it's almost at 35 levels now, and the losses are widening on Infibeam. Another counter which has fallen is Alembic Pharma. Came out with numbers yesterday. Against reaction coming into the numbers. Rain Industries at 160. So there is selling pressure on that counter. The other usual suspects, your Dilip Buildcon and the Dewan Housing, Repco Home, all these counters are dropping in trade. Couple of stocks I want to highlight. Manpasand Beverages now below the 100 mark. It's trading at the lowest point of the day. Tata Communications is trading at a fresh 52-week low. You have counters like IIFL Holding, which are trading at a 52-week low, which are dropping in trade. So there is enough selling pressure that's happening. Other interesting counter is Bajaj Finance has recovered from the lows of the day and coming to the day's high, still trading with a negative bias, but has managed to inch up to the highs of the day because of the Nomura downgrade. The oil marketing companies are looking weak at this point of time. The other infra companies I want to talk about, apart from Dilip Bilkon, is Capacide Infra. Had a blockbuster listing, but post that it's just all the way down. Cement companies are weak in trade. Dalmia Bharat has come to a fresh 52-week low in trade, so there is weakness that is seen on the counter. Among the counters which are gaining among the Nifty, again, Titan has moved to the highest point of the day. Coal India has moved to the highest point of the day, and as Yash pointed out on the Bloomberg Edge, ONGC was looking weak, and ONGC is down in today's trade, and as we speak, Bajaj Finance is almost into the positive. So that's the traction that we are seeing. The Bank Nifty has come off the lows of the day also. Was down over 200 points at one point of time, just down 90 points at this point of time. Dr. Reddy's is doing well. HUL at the lowest point of the day. Mayuresh, FMCG as a space seen considerable weakness. Valuations have come down 20, 30, 40%, almost 10 to 15% from the recent highs, but still they are trading at much higher valuations if you compare them to their past averages. Worth a bet, FMCG, or still more correction?
No, so I think if they correct further, Darshan, I think it becomes a good opportunity because, as you rightly pointed out, I think the valuations have remained on the higher side, and the valuations demanding a premium to the market and to the sector as a whole was based on the premise that volume growth will continue at a very fast pace and it will be a volume-led realization growth. So as I pointed out, I think Q1 was exceptional because of the low base. You might have the volumes average out over the next few quarters. Again, input cost pressures have been playing out for a whole host of FMCG companies. But again, I think the pass-through in terms of realizations by hiking prices is the need of the hour to protect their operating margins. At the same time, I think as they are entrenching their own distribution reach, the over-dependence on wholesale channels is probably receding. And at the same time, I think the kind of SKUs and innovative products which they are bringing out at very attractive price points is going to shore up the overall volume story for these companies. So I think most of these companies have created strong moats around their products and a very strong market leadership position. And that might just continue for these companies. So selectively, as I said, I think if they do decline further, I think the forward price earnings multiples do contract, making it an attractive entry point for long-term investors because the consumption story over the long-drawn canvas of the next 3 to 5 years is still here to stay, as per capita income and discretionary spends increase both in rural and urban India. So yes, companies like Dabur, Imami, Britannia, even HUL on declines probably look interesting.
All right, Brijesh, do you track a West Coast paper on the charts? I mean, the stock on a one-year basis has almost doubled in price. Today's session, though, absolutely flat, but 347 on the stock right now. Is it run too ahead right now for making an entry?
Unfortunately, Devina, I don't track, so would not be able to comment on it.
Okay, not a problem. Anything within the FMCG space, particularly the larger names like an ITC, if you have a view on that?
See, I was looking at the chart of the ITC. Right now, it's been quoting somewhere in 284.95, if I'm not mistaken. 277 and 282 are the two important support on the downside. So, if anything below 282, definitely one can take a buy call with a stop loss of 277 and play for the target of 295 to 296. It has a resistance band of that 1 rupees or 2 rupees, 295 to 297 as such. Anything on the closing basis of that, we can see a sharp pullback to the level of 305 to 307 zone. So, I'm looking for a buy side. If someone wants to play also, 282 would be the ideal level with the stop loss of 277.
Okay, and as we speak, the larger financials are firing. There is IndusInd Bank, which has moved to the highest point of the day. It's up 2.5%. HDFC is contributing, so that one is moving up in trade. So there seems to be a little bit of traction that's coming in on the financials at this point of time. Indiabulls Housing Finance has moved to the highest point of the day. Mayuresh, a quick word on the two-wheeler space. Anything, most of these counters are trading near 52-week lows. They have their own concerns. Anything that looks attractive at these valuations for two-wheelers?
So yes, I think, Darshan, again, if you probably look at volumes, I think the volumes have been quite reasonable, but let's understand that because of the inventory built up at the dealer end, which is anywhere between 6 weeks to 7 odd weeks, and with the festive season probably coming around, there are talks about discounting. And yes, a few of the companies like Bajaj, for example, have come out with a 555 scheme. So yes, at one hand, they probably need to dispose of the inventory pipeline that they have before the festivities continue, and that might probably happen at discounts. On the other hand, there are input cost pressures for these automakers as well. So how do they balance these two things and how do they balance their volume growth going forward? I think is going to be interesting. So I think the first two aspects are clearly going to play out in terms of operating margins. And yes, they've selectively taken cuts in terms of entry-level bikes, but they've also hiked prices in terms of their premium offerings. So a large element in terms of bikes above 160cc, 200cc is where the hikes have taken place. Hero just introduced a 125cc model yesterday. So what probably happens in terms of the management commentaries staying extremely strong in terms of a double-digit volume growth or even a higher single to a mid-teen double-digit growth should probably sustain. The near-term impact on margins will be felt. But as you rightly pointed out, I think the valuations have become very, very attractive for a few of these players. So I think Hero MotoCorp is something that I'll continue to prefer on declines, and I'll hold rating on Eicher and Bajaj continues.
Mayuresh, do you track West Coast paper? Because the stock, I mean, obviously FY20 P estimates of about 7.54. Stock is up 92% on a one-year basis. Had gone all the way up until 399, after which it's corrected and come back down. But as you can see there, the 12-month price change is 90%. Would you have a call on this one?
It's very interesting, Devina. And again, I think if you probably look at the paper industry dynamics as a whole, I think the expectations in terms of different categories of paper are expected to improve. So if you're talking about writing and printing paper, I think that is expected to grow around 4-5% over the next 2 years. The maximum growth that can actually come through within this industry is the packaging boards and the panels, which is expected to grow anywhere between 8 to 9% with muted growth expected to come through for specialty papers as well as newsprint. Now, with expectations of raw material prices, even for this part of the industry going up, both in terms of pulp prices, which for the industry account to around 30 to 35% waste paper anywhere between 40-45% and agro residues, which is almost around 20-22%. I think companies which are using any of these raw materials are going to feel the pinch. Because apart from this, even the chemical prices have gone up. And it's a very water-intensive industry. So I think you've already seen shortages probably happen in a few areas out of South India. A lot of these companies are located in the west and the northwest part of the country. So any issues surrounding water is going to have a huge impact in terms of their margins. But because of pricing moving up, what you've probably seen in terms of dumping or the anti-dumping, specifically in terms of uncoated paper, I think the higher varieties of papers which are manufactured, whether that is the coated paper that you're talking about or the board packaging paper which is of high quality, I think companies manufacturing that will at least be able to pass through in terms of higher realizations, or even the colored printing and writing paper which has higher realization cost-throughs, push-throughs. So in that sense, yes, I think the industry looks interestingly poised. Selectively, I'll probably be having a call on this sector. So companies like an Orient Paper, for example, look very, very interesting. West Coast has run up very, very sharply. I think one should really monitor the numbers before taking a call on this stuff.
Okay, cement is taking it up to the chin. Dalmia Bharat 52-week low. You have your Ramco Cements at 52-week low, Ultratech at 52-week low, Shree Cement at 52-week low, India Cements hit a 52-week low. Cement pack is taking it to the chin literally. Brijesh, any shorting opportunity in the cement space?
It is a Ambuja Cement result. And purely from a chart point of view, it suggests that 199 has been quoting and it has breached the recent swing low of that 201 or 202. So if on an immediate basis, one can go for a sell side with a stop loss of 203 and play for the target of 192 to 193 zone.
All right, guys. Thank you so much, Brijesh as well as Mayuresh. Appreciate both of you taking out the time and sharing your views and thoughts with us here on the show. The markets is still in the red, but not at the lowest point of the day. For the Nifty, we're down about 0.8%. Banks are losing closer to 0.6%. We're going to take a very short break, but coming up, we discuss the pain in the real estate sector with S. Sriniwasan of Kotak Investment Advisors.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, रेज. अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, बट पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Well, the markets are volatile, investors are confused. We are here at the Motilal Oswal dealing room with Yogesh, and I'm Yatin Mota. Yogesh, I'll not ask you to guess index levels for us, or I'll not ask you the typical question, market kya lagta hai, but I'll ask you, what are you right now advising to your clients? What is the strategy and how are you really approaching the markets?
Okay, many questions at one go, but I'll answer turn by turn. That markets are quite in a consolidation plus volatile phase right now. And what we believe is that the crude and the iron are earlier there were the biggest concern. Now, in addition to that, the NBFC crisis which has come to the Indian market, so that shows some kind of we are not so confident about the market view right now.
Okay.
So more on the bearish side. So we are not asking clients chance to get into investment ideas anymore at this point in time, but get into the stocks where the valuation comfort level is there, rather than getting into expensive and the growth-oriented companies. So we are going on the defensive side. Secondly, the strategy is a similar one where Nifty numbers are not so important, 10,000 or 10,200 or 10,500. It is a sentiment of individual investors come trader to have our trading positions as per the stop losses in mind and in practical as well, so that to curtail the losses. You never know what will market open next day morning. We didn't dream that market will open at 100 points below the yesterday's level. So that way.
So Yogesh, index has been doing a gap up, gap down. Very difficult for even to take a trading call with stop loss. But any specific Nifty levels that you are watching out for, or are you advising your clients to watch out for specific Nifty levels?
Specific Nifty level was earlier at 10,750, which was a 200-day moving average. We saw a bounce back, but from there we saw that again carnage happened. So 10,138 was a swing low earlier, from where we saw a pullback. So if it closes below that, then we can see that the entire rally, which started from 9,852 to 11,760, may get over around those levels. So we may see some further selling spree below this level, and market can go down to maybe breach that level 9,851 earlier.
Yogesh, there is a real scare in banking, NBFC, real estate, and everything is moving around funding. Real estate cash flow is getting impacted because of the slowdown. So any specific opportunity that you would like to capitalize in the real estate space, in the NBFC space? Any buy on dips kind of a strategy in these two sectors, or you would simply ask your clients to stay away?
Yatin, basically we never dwelled into real estate sector per se, rather, the direct developers. We have only Oberoi Realty, which is a debt-free company, so there we have a great comfort and we can ask our client to get into that. Apart from that, on the real estate sector, what we would prefer is the real estate developer funding. So those lenders are available here, like India Bull Housing Finance. These are the names like Piramal Enterprises, where they are lending to the top 80 developers, 80% of the developers of India. So the correction will provide a better opportunity or greater opportunity for those companies to invest into. Piramal has corrected from 3,300 to now 1,800, 1,900 odd. So here we can get into in tranches. We are not recommending to get a one go, but in tranches one can always look at have a partial investment or maybe a trading kind of sort of bet here.
And the result season has started. We had a lot of disappointments of late. Also, if you look at shares like IndusInd Bank, they corrected 8% yesterday. Today, Asian Paints is down 6%. These are all, good blue chip companies which everybody wanted to own. But now, there is a certain, bout of, selling, if I may say, which is coming into all of these stocks. So, how do you really approach these large caps on corrections?
What I would say is these are the phase of the markets. Earlier we saw small cap and the mid caps carnage by 40%, 50%, and there is no respite. They are not bouncing back by even 5-10%. Now these markets are not moving and people are frustrated, it seems, and now the flow, FIs are also selling. So they have started redeeming from their profit-making, it seems that profit-making opportunities where they are pocketing their own profits. So probably that is driving force for, selling into the blue chip names. But however, these all are mainly Asian Paints are largely on a higher P multiple, though the volume growth is in 10% plus. So that shows some kind of a comfort level. But however, valuation comfort is not there. IndusInd Bank is a different story where they came out with the analyst week call that they have got exposure of ILFS and they have done provision for that. And the commercial vehicle funding is more of the business on the higher side. So probably that will provide a good opportunity to get into it 3 times less than 2.8, 2.9 times price to book multiple FY19. So that will provide a good opportunity again to get into. We saw some good migration from high price to book multiple banks, private sector mid-sized bank, to now getting into ICICI Bank and Axis Bank. The flow is going there post Yes Bank disaster. So these are the strategies we are driving for our customers.
And you still prefer private over PSUs? Were you scared with the SBI announcement of they intending to raise or probably getting a resolution for 20,000 crores equity?
It is too early to say. 20,000 crore is a very tough task for them, and it may take some, February, March deadline to raise those funds without diluting their equities. But so far, we would prefer private sector banks over public sector bank because of clearly we look at the opportunities to pocket in from wallet share from public sector bank to private sector bank, and that will drive the growth of 20-22% for individual names like HDFC Bank, for IndusInd Bank, even for small size RBL Bank.
Okay. And one final question on auto, since you were talking about commercial vehicle financing, from Ashok Leyland to Maruti to Bajaj Auto, Hero MotoCorp, all the segments in the auto sector have been under pressure in terms of volume growth forecasts, and also a stock like Maruti has corrected 25-30%. How do you really approach this sector? Do you think there is opportunity here?
Definitely, I think yes. In select names, there are opportunities. Two-wheelers, we think that now it has got segregated, and Bajaj Auto, Hero MotoCorp, they are having a plateau kind of a sales in 6 lakhs, 7 lakhs plus kind of numbers for Hero MotoCorp. But margins are not improving, and the tough competition with the cutthroat competition on the prices. So that is driving down some negative factor for those companies. But however, 2700 for Bajaj, 2700 for Hero, or 2500 for Bajaj, we need to see the results for Bajaj today, tomorrow. So that we see that there is a comfort. However, upside is not visible at this point in time. Maruti especially, I would say that the correction is very healthy for them, provided if we see that there is any decline in the margin, because margins are not improving, though numbers have improved by 14-15% YOY. Right. Earlier they used to do 130, then 150, now 165 to 170 vehicles per month. So if there is any decline into that and any royalty, if we see some surprise or shock from the royalty part, then we may see some further dip into the prices. But unless and until that happens, we are very confident of about 15-16% growth, and around 375 or maybe at a conservative level by 350-360 EPS. It is fairly valued right now, so there is no expensive valuation in sight right now.
Okay, thank you, Yogesh, for speaking to Bloomberg Quint. Of course, that's the word coming in from Motilal Oswal. They do believe that there are certain opportunities in the market, but buy in small tranches, buy on dips, and also more importantly, do not be in a hurry to construct the portfolio, since they are right now in a mode wherein they are advising clients to take select trading positions and not large investment positions.
His recent post on LinkedIn has created quite a stir, not only because it raises some tough questions, but also because he's the managing director at Kotak Investment Advisors. A banking veteran of 25 years, Sriniwasan asked how NBFCs, which have a sizable and seemingly ever-growing exposure to real estate, have hardly reported any NPAs from the sector so far. Joining us now to talk about that in more detail is the man himself. Mr. Sriniwasan, good having you. Thank you so much for speaking to us at Bloomberg Quint. My name is Neeraj here. Good morning. Do you believe that the next 12 months could be a bit of a litmus test for both real estate as a space because of the crunch in liquidity that was available thus far, and in turn for NBFCs which have a sizable exposure to the real estate portfolio?
See, the real estate sector itself obviously has gone through a fair amount of challenges in the last 18 to 24 months on account of various regulatory changes, whether it is RERA, whether it is GST. And of course, there is a negative sentiment on real estate, broadly on account of the fact that returns on financial instruments have been far better than real estate. So money has actually moved to financial savings rather than direct real estate exposure. But unfortunately, that financial savings has manifested itself into easy credit to real estate NBFCs, who have then gone and funded a number of these developers where the end user demand has been quite challenging, which is what I have posted. I think as far as the sector is concerned, you would see potentially challenging times for existing high-end projects, but on the more affordable size, or where developers have launched new projects which are better priced, better sized, those are seeing early upticks. And as long as somebody has a portfolio of those kind of projects, I think they should be okay. Similarly, for financiers who have financed those kind of projects, they should be okay. But the challenge has been that bulk of the credit growth of NBFCs has been on projects which had been in the works for the last 3 years. Many of those were in the luxury segment, high-end segment, very slow-moving inventory. And to expect that cash flows will come from those slow-moving inventories in the short term is a very charitable assumption.
So what happens in that period, Mr. Srinivasan? I mean, I know of a bunch of developers myself who have a line of credit open with NBFCs. The last 1.5 months, not even 1% or 2% of that line has been disbursed. And these are large players with some amount of luxury retail or luxury residential exposure as well. What happens in the intermediate period, if they are not able to sell that, they are not massively indebted, but yes, they have cash flow issues, and now NBFCs have stopped lending to them.
I think stopping of NBFC lending to real estate is a temporary phenomenon. Obviously, given whatever has happened in the market, everybody is going to go back to the drawing board and reassess risk. And in that sense, in that period of reassessment of risk, people would not want to take active calls. So what would potentially happen is that the better capitalized developers, the developers who have the brand and the ability to actually execute and sell, will potentially see their credit lines opening up again in the not too distant future. Although some of the cost of that capital will obviously be a little higher than what they were originally getting at. And that is essentially a transmission effect of the cost of capital that NBFCs are likely to face. Given whatever has happened, the NBFCs are also going to be finding it challenging to raise capital. And or if the well-capitalized one again will be able to raise capital, their credit lines will open up, and but they will be probably at a slightly higher cost. So how much of that cost is going to be transmitted down the line to potential borrowers is a different question, and I think there will be in the short term some kind of margin contraction for NBFCs as well.
So you've seen many such cycles, Mr. Srinivasan. How long do you expect this one to last? I know it's very difficult to call an exact timeline here, but to your mind, do you think this pain, if I can use that term, lasts for the next 6 months at least, or is it 9 months at least, or is it something that is not possible to define right now?
See, I think the cash flow pain for NBFCs and others could potentially last for another 6 months and some of the well-capitalized developers. But on the industry side, I think you really have to divide it into two time zones. I think there is a time zone prior to the last, let's say, 12 months or so, when many of them had fully committed themselves to develop very high-end luxury projects, and it's just that everybody jumped into the same bandwagon. Part of the reason why Mumbai is in doldrums is there is a massive amount of supply of inventory which is either already standing there or in advanced stages of execution. All of those inventories are apartments which are more than 10 or 15 crores. Now, how many people can you sell apartments worth 10 or 15 crores? It will take a while for those to actually get liquidated. So if you are a developer who has only that kind of inventory and you are leveraged, I think you're going to be in trouble. But if you have a diversified portfolio where you are able to get cash flows from other projects which are more affordable or more sensible in terms of pricing and location, I think those guys will survive.
Okay, let's ignore a portfolio of a developer, Mr. Srinivasan, just trying to nail it into high-end property versus mid-sized properties. Now, if the poster boys and the prices of the poster boys come off, if not don't get peeled off completely, but come off marginally or come off quite substantially, the ripple effect would translate into the smaller properties and smaller ticket sizes as well? Or do you think there the price destruction or damage would be very, very limited because of the demand-supply equation?
See, unlike the equity capital markets that your channel caters to and other channels caters to, the prices coming off is not easily visible in real estate. Real estate is an industry which is generally in slow motion. So the prices will come off, but it is like a leaf falling down. It will come slowly. And it will first come out in disguised pattern, which has already been happening for the last couple of years. Parking lots are free, floor rises are not there, and so on and so forth. So you will see gradual decline in prices, and in real terms, if you adjust it for inflation, it's a much steeper decline. So there will be time correction in prices in many of those cases that you will be able to see. And at the end of the day, if the developer is not able to sell the inventory or if he's holding on to prices, then potentially the lenders will go and foreclose and try and sell those at a clearing price that makes sense. Obviously, that assumes that the project is completed. If the project is not completed, it's a different ballgame.
Would developers be able to sell at clearing prices which make sense, or do you believe that there could be a possibility of distressed sales happening and large distressed sales happening?
Well, it's not easy for existing developer who has already sold some part of the inventory at a higher price to overnight say that, now the inventory is available at 20% discount. Unlike in equity markets where, if I bought Infosys yesterday at 1,000 rupees and today it's 800 rupees, I won't complain because it's a call that I have taken. But in real estate, the homeowner who has bought it at the higher price will show up at his doorstep the next day and demand the same lower price. Obviously, the same homeowner will not complain when the price goes up. So, and it's not an easy task for developers to actually deal with that kind of situation. It's part of the reason why you don't see headline advertisements where people are saying, "Oh, my inventory is now down 20%." Nobody will do that so easily.
Yeah, but that notwithstanding, I'm just asking, right now also the experience suggests that if you have a checkbook in hand and if you're going in and buying in the flat, then you're getting it at a 10, 15, 18, 20% downtake as the case may be and as much distress the developer is in. My question largely is that because of the crunch of liquidity, if the developer needs money and the money is not coming in from the NBFCs as it was coming, the only choice that a developer arguably has is to sell off his property and the buyer is only willing to buy that property at a 15, 20% downtake. Do you think that will happen sooner rather than later?
Well, there are many ways in which they will liquidate the inventory. Either an existing inventory can be liquidated to other bulk purchasers, and there are real estate funds which have that strategy to buy apartments on a bulk purchase basis. There are other undeveloped land parcels where the borrower can actually liquidate or invite some other developer to develop it and generate quicker cash flows. So there are many ways in which cash flow can be generated by the developers, but not necessarily only by liquidating an existing standing inventory.
Okay. Now, I just want to shift the focus, Mr. Srinivasan, to what does all of this do to NBFCs? There's a bit of a ripple effect or a bit of a quid pro quo out here. NBFCs gained because they were able to lend to real estate companies at higher rates, or as the case may be. Now, what happens if and when real estate companies, some of them, if not all, are not able to pay the money back on time? I mean, the Supertech case was a classic example. A lot of other names also came into play in the last few days. How do you think that piece of the puzzle plays out from the NBFC side?
Well, as far as NBFCs are concerned, obviously, they are, relooking at the risk assessment that they have on their books. Having said that, without getting into specific names, I can only draw upon some of the experiences that we have had, where it is important for a lender to be in a position to proactively take charge of a given situation. I'll give you an example. One of the situations that we had bought into from our real estate fund was a NPA. We bought the debt. We had to put in additional capital, but we had to take complete control of the project, put our own project management team, change the business plan from that of, it was a commercial project from leasing to sale of smaller offices. And monitor that literally on a weekly basis to generate cash flows. We are successfully being able to launch the sales of that and generate cash flows. What it taught us was that if you are a lender and if you are only relying upon the execution skills of the borrower, and if it is poor, you have no choice but to roll up your sleeves and get down to hard work. And some NBFCs have already started doing that. Others may take the foreclosure route. Some others may force the borrowers to, if they don't have the capability to actually generate the cash flows, to invite or sell the project to a better developer with a better brand name and better execution skills. So these options have to be explored by a lender if cash flows are not being generated.
Mr. Srinivasan,
there is no substitute to hard work.
Yeah, but Mr. Srinivasan, that might be even possible and relatively easy for a larger player like you or some of your other peers. But a bunch of other mid-sized NBFCs where the pool of liquidity that was coming in almost an unending fashion, the taps are now being turned off because mutual funds might not be able to or willing to roll over some of the papers as well that are coming up. And that's just one piece of the puzzle. Banks might not be willing to lend in a meaningful way compared to what they were in the past. What happens in such scenarios? Mid-sized NBFCs, mid-sized lenders, and that ecosystem, is that under a bit of a threat?
Like in nature, survival of the fittest. So if you are mid-sized, you might either get eaten up by a bigger player or you go out of business.
Well, do you sense that? Again, all of this is conjecture at best, Mr. Srinivasan, but in your case, it's an informed opinion coming from you. Do you believe that the stress for some of these NBFCs could be rising to that pocket wherein there could be defaults from mid-sized real estate developers to which they have lent, which in turn would harm their flows and therefore could be a bit of a pickle for the mid-sized NBFCs as well?
So, look, I think defaults or delays in payments have been there in the industry. It's not that it has not been there. I think it's, and the industry was able to manage it because there was ample liquidity in the system. Now that liquidity is sort of coming to a halt, and hence the ability to manage a delayed payment and therefore recognizing as a default is significantly reduced. And so some of the truth will actually come out when people will have to call out the defaults. Secondly, I think in the last 3 years, given the ample liquidity that was there in the market, there was, every existing position of a lender was being refinanced by another lender. I'll give you an example. We have exited our latest fund of $350 million. That exit has happened because we took the call that there is too much money chasing these assets. Some of this money has been have been very charitable in their assumptions in terms of loan to value and mispricing risk. So our fund was a credit fund, and we had given significant credit to the industry. And many of those, in fact, 70% of those credits that we had given out, we got our exits because the NBFCs were charitable, and they were 70% of the exits was from refinancing. So, so that has generated for us and our investors a 19% IRR. What that shows is that the cash flows are not coming out of project executions and sales. The cash flows are coming out because the Ringa Ringa Roses is going on. And we all know what happens in Ringa Ringa Roses.
Yeah, when does the music stop, Mr. Srinivasan, or has it already stopped?
I think music is already, toning down, and the smarter guys are getting out.
Okay. One final question, Mr. Srinivasan. Do you we spoke in this interaction about the possibility of consolidation of projects, and frankly, even I personally know of people who have had mid-sized projects go out to larger developers and telling them that please take my project because of various difficulties, including their ability to comply to the RERA norms and the completion timeline, so on and so forth. Do you reckon the same could happen within the NBFC space as well? Some of smaller parcels or smaller portfolios, or maybe the whole company by itself could be up for grabs?
Well, it depends upon the leverage level in the company and the nature of the leverage that they have. If they have a substantial short-term leverage in their balance sheet, and if they are not a very well-known name, they will have challenges. The only way to deal with that is either sell some of your assets, which is your portfolio of loans, and if they have decent loans, they will find takers for that, or you have to raise equity. So today, with the equity markets being very skeptical about NBFC space, few well-run NBFCs will be able to get capital. It's not as if investors are turning away from the financial services industry per se from providing equity capital. The latest news, for example, this morning about a number of investors lining up to look at Lakshmi Vilas Bank is an indicator of the fact that there is a deep interest in financial services. So well-run NBFCs, well-managed NBFCs, investors will understand and recognize that the management quality is good. It's a short-term liquidity issue, and they will potentially take the benefit of the corrected valuations of NBFCs and put more capital to use. The reality of it is that the banking system in India today does not have enough capital to fund the needs of the economy. And NBFC is a reality. It is not that NBFC guys are going to shut down and run away. You will see survivors, and I think those survivors would certainly have learned to run their businesses much better. And we ourselves have gone through this kind of situations back in the 90s, and and those lessons are very important as you build a long-term business.
Okay, last question. Just looking for a headline. Do you believe there could be fire sales, NBFCs or real estate, or the situation is not as tough as 2008?
No, it's not as bad as 2008. I don't see a fire sale. don't, one or two instances here or there is not going to be, it may give a negative sentiment, but I don't think it's as bad as 2008.
Lovely to hear that. Mr. Srinivasan, thank you so much for taking the time out and speaking to us at Bloomberg Quint.